Hello and welcome to your Global Markets Technical Outlook for the last quarter of 2021. Normal disclaimers apply as we get straight into the US stock market, and as it's the last update for the year, we like to have a look at the long-term chart for the Dow, in this case, going all the way back to the beginning of the previous century. And if you recall, it's characterized by these long sideways consolidation areas which are punctuated by these rising bull trends, one from the late 1940s up into the 60s, where it consolidated again until the early 80s, and then we rose up towards the late 90s. Through that consolidation period, the tech crash, the global financial crisis, and then since then, in 2009, we've been rising ever since. Now, the markets are starting to look a little bit parabolic at the moment, but if you take a step back, you'll see that we've only really done about 400% since 2009 compared to these previous legs that were up in the 1500s and 1300s. So it's possible that we've only really seen, a small part, maybe a quarter or less of the amount of increase that we can see during this bull run. That doesn't mean there won't be pullbacks along the way, as we saw here in the 1987 crash, which seemed immense at the time, but as you can see now, it was just really a blip on that overall up move in towards the 90s and the 2000s there. So overall bullish, of course. I mean, the Dow is a big rotational trading strategy by definition that has lots of survivorship built into it, and so it can usually do nothing else but go up over the very, very long term. Drilling down into the monthly, and that there is that parabolic move that I just alluded to. I'm going to leave the bubbles up here because it does seem to be a little bit bubbly up here. We blasted straight through that 4,000 level and almost heading towards 5,000 now, as you can see there. So it doesn't seem to be anything that wants to stop this market, not at least not in the short term. All the pullbacks are currently being bought, and we're back into all-time highs again. And the weekly chart, you can see that again, and from these these COVID lows, let's call it, back in 2020, you can see we're now up 114% since that period. That's a huge increase from any point in the market, really, but over the space of a little less than 18 months, really, that's a huge increase. So it does make you wonder how much more life there is left in this leg. But you shouldn't stand in the way of a bull market, as the old saying goes. On the Ichimoku, we can also see that the market's still very much bullish above that cloud pattern. The Chico span or lagging line well above the price and the cloud, and these other two lines far apart. So everything pointing up in the meantime, and if we do get some sell-off back to the cloud, 3,900 to 4,300, we would expect some demand to start showing up. Switching now to the market fundamentals, and first of all, the bullish percent index, which as we've come out of this latest correction, we're back to all-time highs, really, but we are starting to see the decay of the number of stocks making bullish patterns and breaking to the upside, as this chart shows, down around 53%, which is a fairly anemic number for all-time highs to be driven by, and that kind of points towards that concentration that we're seeing in the market. It's losing some of that breadth and becoming much more concentrated in a few of those larger stocks, and we'll have a look at that in a second. Same goes for stocks above their 200-day moving average. You can see also around about that 53% mark. So these charts are not great timing tools. Even though the breadth is low, it doesn't mean that it can't continue to be low and we can't continue to make all-time highs. It just means that eventually this will be the undoing of the market, but we may not be there yet. And this kind of chart backs up that thesis that we are seeing the domination of a small number of companies, primarily the FANG stocks, really making up about 25% of the market. the S&P 500, that is, and that's a huge amount, much higher than it was back in 2000 at the tech or the internet bubble crash, the tech wreck. So we are in a highly concentrated environment with a lot of the money chasing those growth stocks and not distributed across the smaller caps again, as we'll see as we get a bit more. That concentration is usually unhealthy for the market in the longer term, but in the short term, while those growth stocks are going up, well, then that's going to allow the bull market to continue in the short term. On the bright side, though, we can look at things like discretionary versus staples, which is often a leading indicator of the market, versus the S&P 500 down here. You can see it's tending to agree with the index itself. It's making new highs as the index is making new highs. So that's one element that is generally bullish for the market. Same if we look at the semiconductors to the S&P 500 itself, so how far or behind the semiconductors are outpacing the index. In this case, they are outpacing the index since way back, really. And again, also making new highs, which again is bullish for the market because semiconductors tend to be a leading indicator. On the advanced decline line, we are just seeing it turn a little bit more sideways over the last 6 months or so. So you could argue that's maybe a little bit of a type B divergence starting to form there. And the market obviously still going higher. This is obviously indicative of those kind of 50-50 market breadth readings that we're seeing. Half the stocks going up, half the stocks are not. So we're getting that flattening of the advanced decline line. Now, it can recover and move higher as it did back in this area here. So I don't think it's anything to worry too much about yet, but it's one certainly to keep an eye on. I just thought I'd throw this one in because the supply chain squeeze and bottlenecks that are in the news at the moment. And this looks at the Baltic Dry Index, which is a good proxy for shipping costs globally. And you can see here that since those corona lows back in 2020, this has moved up 750%. So that's obviously going to increase the price of moving goods around the world, getting the stuff that you want for Christmas and so on, which obviously feeds into inflation as well, and that may end up being a bit of a bogeyman for this market too. So shipping costs definitely on the watch list at the moment. Looking at the three big indexes of the US, we can see the S&P 500 and the NASDAQ both up there in the mid to high 20s, whereas the Russell, as alluded to earlier, which is the small caps, not faring quite as well. So that, again, just indicates that the concentration of the market, the Russell being much more broad-based, the smaller caps, the so-called engines of the economy, are really getting left behind by these huge growth stocks that are driving the S&P and the NASDAQ higher. On the yield curve, we are still in that steep formation, the so-called normal shape of the curve, which indicates that, money is very cheap. We know that, sure. And there's no money to be made in bonds at the moment compared to the stocks. So you get this TINA effect. There's no alternative driving money from all other asset classes basically into stocks, because that's where the returns are at the moment. With that said, there is some signs that the yield curve may just be starting to flatten a little bit. It's not much at the moment. You can see these shadow lines below the 2-year and the 10-year here, and if we look at that as they split on a chart, you can see how they were steepening through after that corona crash back through 2020 into 2021. The gap was very wide, and we're now seeing that gap starting to narrow. So that does indicate a flattening, and that's important because that indicates that the cost of money is rising, and interest rates themselves may ultimately rise, and this may all be due to the rise in inflation that we're seeing, and all of those things are risks that will ultimately feed into the stock market. We'll have a closer look at that in a moment. On the sentiment, you can see here how we've been riding this lower extreme of the put-call ratio, which indicates there is a imbalance towards calls and away from puts. In other words, people very bullish about the market and expecting the market will go higher and higher. We have obviously seen short-term correction just recently. That's now passed, and the put-call ratio is starting to revert back towards that middle area, but no sign of it getting back to the sort of middle of the range that we saw prior to COVID through 17, 18, 19. So it does indicate that there is that sort of funneling of funds in pushing this market higher and higher that ultimately may not be too healthy, but while the party's on, there's no reason to leave just yet, as they say. On the volatility index, you can see as well that latest correction that we just had, which pushed the VIX up into the 30s, now reverted back down into the teens. So we are back in that low risk area. You would expect that once we've seen one of these peaks, as has happened in the past, the VIX is very mean reverting. When it does revert, it tends to stay low. So we should expect that this latest leg up may continue. In fact, it may be due to some seasonality again, which we'll have a look at in a second. But often into the end of the year, we see the so-called Santa Claus rally and so on, pushing stock prices higher. So we could be seeing the beginnings of that, given that where we are in the annual cycle. So a quick trip down the through the looking glass, and let's have a look and see what we can divine from what we're seeing in the markets at the moment. I think there's definitely a few market risks around at the moment, and this is an interesting chart looking at the relationship between US 10-year real rates and the Nasdaq VIX, which is the volatility of the VIX index. So you can think of it as inverted to the index itself. And you can see how real rates, of course, are the interest rate minus the effects of inflation. And you can see how it's been trending lower, and every time the real rates have jumped, it's caused the volatility index for the Nasdaq to also jump. Now, the risk, of course, is that if the real rates start rising, then this will this will impact negatively onto the Nasdaq itself. And why is that? Because most of the big tech stocks are what's called duration plays. They're very sensitive to rates because their future earnings, which is what they're priced on, can be affected negatively by higher interest rates. So if we see real rates starting to rise, that could be an impact negatively on the price of those big tech stocks. And given that they're such a big part of the overall index, the S&P 500 and so on, that could be one issue for the market in terms of continuation of the bull market. Another risk to keep an eye on is the price earnings ratio, which is at these sort of stratospheric levels we haven't really seen since the internet bubble days back in 2000. And why is that important? Well, it's because the higher the PE ratio when you invest your capital, the lower the future returns tend to be. In other words, there's an inverse relationship there. This is an interesting scatter plot here looking at the starting PE multiple on the horizontal part of the chart here versus the return after 5 years up the vertical line here. You can see it's a pretty good correlation there on that linear regression line. What's interesting is where we are now. This in 2021, we're way up here in the high 20s in terms of PE, and if we look at what that produces over a 3 or 5 year period, well, it's only looking like 7%. 7% over 5 years is just over 1% per annum. So the future returns start to look less and less rosy the higher this PE number tends to be. So again, another risk to the overall bull market continuing certainly at the same pace that it has anyway. On the upside, though, we are into this bullish seasonality area now. We're into December, the Santa Claus rally, which I've also mentioned. January also tends to be quite bullish as well. So it could be that we get through December, January, into the early part of next year, into that sort of March, April, May even period, which can introduce a little bit more volatility. So sort of short-term bullish, but bigger, longer-term risks for this market. Which brings us on to seasonality itself, and we look at the year to date. It's been a reasonably good match, you have to say. The market's certainly been more bullish than the seasonality, which of course is an average, so it's going to have down years in there as well. It's indicating more flat through the middle part of the year. The index obviously kept rising, but we did get that volatility through September, October. That's almost a picture perfect match for that. And then this latest pullback in early December, as we've just seen here, and the annual seasonality, as you can see here, is quite bullish in towards the final part of the year. On the presidential election cycle, we can see that it was a reasonably good match up until about August here. Then this was the Dow we're looking at on the bottom chart here. We got that sell-off down into a low here. But on the actual outcome, it was the opposite. We pushed up into a high around about this period. So it's kind of disconnected a little bit after about September, let's say. Now, we've just had the post-election year. I guess the big question is what's next year? Well, next year is what they call the midterm year. And if we have a quick look at that, you can see it's much more choppy, much more up and down, no real clear trend in this chart. So it will be interesting to see, especially given the sort of big rise that we've had over the last year or two, how this now plays out, whether we do get some consolidation, maybe even a deeper pullback in 2022. On the decade cycle, once again, this hasn't been a great match this year, certainly year one, but year two, which we're heading into, starting to reflect that midterm year, remembering that presidential cycle's 4 years, this one's 10 years. So interesting that they line up this time around. So will be interesting to see how that plays out, if indeed it does. And Calvert-Clark's decades pressure chart, you can see here the rate of change. This pressure now really pushing lower and may actually start recovering. So see how this plays out. Maybe this indicates a bit more choppiness that we're going to come through, and maybe that we're finished with the sort of higher momentum that we've seen in the market. Switching over to the Aussie stock market now, the XJO, we have completed, I guess, what you might call a ascending triangle here. We had the COVID issue sliced right through the bottom, but quickly recovered. Now back above the old all-time highs at 68.50, also above the 7,200, which on the weekly chart we can see was the pre-COVID high, and nicely just consolidating above that level, which does indicate some short-term bullishness for the XJO. On the Ichimoku chart, the Australian index still very bullish, well above the cloud, lagging line also above the cloud. So nothing to write home about there. Business as usual. The cloud itself around about that 6,700 to 7,250 level, let's call it. Comparing us to the other bigger indexes in our region and the US, the S&P is the clear winner, of course, way ahead of everybody else. The XJO, or the ASX 200s, has been much more sideways, especially the sort of back half of this year, ending more or less about 12% where we are now. The Asian, or let's call them Chinese indexes, the Shanghai and the Hang Seng, not doing quite so well, only up about 4% in Shanghai and down about 12% for the Hang Seng. So mid-range for the ASX 200 by comparison. Switching to the currencies now, and on the US dollar, short-term bullish. This 90 level is the one we've been watching. It's blasted through that back in 2014-15. and it's bounced off it twice now and managed to recover both times. 3 times you could argue, really, a couple of times just recently. Now heading back towards the middle of the range. Do we make another attempt on this 103 area? I mean, it does seem to be where it wants to head. Maybe with the rising interest rates and the rising bond rates and so on in the US, that's certainly giving the US dollar a little bit of a fillip at the moment. On the Aussie dollar, it's going in the opposite direction. One, because of the impact of the US dollar, but also because of the impact of iron ore prices, which we'll have a look at in a moment as well. Didn't manage to break through that 80 cents level, and now languishing down back about 70. Just finding a little bit to buying coming in there at the 70 cent level. But it needs to stabilize and move higher from here. Otherwise, it looks like it might be through that 70 level. And 65 would be the next stop, and then possibly 60 after that. But for now, holding the line, let's say at 70. On the euro, broke out of this descending triangle and it managing to consolidate and hold just above that downtrend line. $1.23 is the line of resistance for the euro. So again, if it can stabilize in here, obviously it's heavily influenced by the bullish US dollar. So for now, it's fighting that tide, and if it can stabilize and move higher, then 123 becomes the next hurdle for it. On the British pound, missed out on getting across that 145 level, so really just back into this consolidation area right in the middle of the range. Nothing really to talk about here other than it might bounce, go down and have another test of 120, but very sideways for the last few years on the British pound. And on the Japanese yen, looks like this is now a failed ascending triangle. We're down through that trend line. Didn't manage to get back high as one as that 1 cent area. And 0.8 of a cent, I guess, is that line down there. That looks like where it's heading. There's not really much in the way of support before it gets down to that level. Again, the bullish US dollar influencing the yen negatively. And on the Bitcoin, well, it's been a volatile month or two for Bitcoin itself. It did, you would have seen the headlines when it hit 68K there, but that's been sold off quite heavily. It bounced off that sort of 44,000 level, let's call it, and just stabilizing in around that 50,000 mark there. So it does seem to be in a sort of big consolidation area, or rising wedge, you might call it. So does it revert and move higher? But again, it's crossed with the US dollar, so that will be impacting on it as well. Not really sure where it's going to go, except probably stick within those trend lines for now. Finally, on the commodities, the crude oil, we're in this kind of descending, or we were inside this descending wedge pattern, which it's now broken free of. It did briefly trade above $80 a barrel, but it's sold off a little bit since then, just sitting in the 70s, but consolidating nicely above that trend line. So that does make you think it's probably a little bit more bullish short term for crude than bearish. And on the gold, well, it's had that false breakout above 1900, and it's now just consolidating under that area, but the high 1700s at the moment. That does make me think it will probably have another attempt. There does seem to be, the buyers and sellers are locked in a battle here, but we did get this kind of rounded bottom formation, which does tend to be quite bullish. So maybe we're just getting a mirror of what happened back here in 2011, 2012, and maybe it's some sort of extended head with a couple of tiny little shoulders before another breakout on gold. And on copper, we can see it did that $4.60 area, didn't quite manage to get. It's kind of looking very similar to gold at the moment, where it's just consolidating under that area. I'd say it's probably more bullish than bearish while it stays up in that area. If it could stay above the $4 mark, I think that would be more bullish than bearish for copper. And finally to iron ore, well, it's at a terrible time, isn't it? It's down 52% from its highs up here around about 220. And it's really just not really showing any signs of recovery at the moment. We can look back now and say this is just a huge bubble. It was up, 100%, and then it's down 50%. So it's acting a bit like a cryptocurrency, really, in that sense at the moment. And iron ore, obviously, there's a lot of economic factors and supply and demand factors that are driving this price. But in terms of technicals, it really needs to try and consolidate and, get the volatility under control before it's got any chance of moving higher from here. And that's obviously feeds into the US dollar, as I mentioned. So just to summarize that, US stock market's looking very parabolic, but we do have seasonality behind us. So maybe we'll limp on into the new year before we see any of those more systemic risks that we spoke about rearing their ugly heads. On the Aussie 200, consolidating above those all-time highs, so that definitely seems more bullish than bearish for the Aussie market. And that bullish US dollar on the currencies causing weakness in the other majors. And on commodities, we're seeing the energy markets and the metals very bullish. Thank you very much for your time. I hope you found these useful the course of this year. We will be continuing them into next year. If you have any questions or comments, track me down by email or on Twitter, or have a look through my website. And with that, I will wish you all the best for the end of 2021. Good wishes for 22. Good luck, good trading, and bye for now.